Hello again. This is yet another episode of The Red Jacket Lawyer, providing you with guidance on German law in English. Today is part 2 of what foreigners misunderstand about German capital companies. If you like what we are doing, please like and subscribe. If you've got questions or comments, please let us know. We will do our best to accommodate your feedback. Now back to part 2 of what foreigners misunderstand about German capital companies. Today we will talk about more common misunderstandings about German capital companies, connecting to the last episode we did. And accordingly, we will continue with point number 4. Point number 4 relates to 25,000 euros of share capital means frozen cash forever. For a standard GmbH, statutory share capital is a legal capital concept. There is no way around with that corporate form. However, it does not mean that the money must sit untouched in a bank account permanently. But it also does not mean that you can extract it freely. Capital maintenance rules still apply. In essence, the company under your directorship can work with the money, you can spend it, you can invest it, but you have to act responsibly in line with the corporate governance rules, etc. But it certainly doesn't mean it sits there like in a savings account. Number 5, buying or selling shares is always quick and easy. In some jurisdictions, a stock transfer can be quick and informal. In Germany, transfers in a GmbH usually require notarization. So have a look at the video on notaries. That entails timelines, costs and process. So planning does matter. Another misconception, number 6, is that a company eliminates all personal risk. That's a myth. Limited liability is powerful, but it is not absolute. And depending on how far you stray off the safe ground, you do incur personal liability. And examples of such personal liability can include when you give a personal guarantee to back up the company, when you incur director's liability for tax exposures, for fraudulent conduct, for wrongful distributions of company assets, or for some insolvency related matters. So whilst the regular day-to-day business is shielded, a rogue director will essentially remain liable. Number 7 on our list is the UG is the best and cheapest option. That's a myth. The UG can be useful for small startups, but counterparties may prefer a GmbH. And the UG, of course, has reserve rules designed to build up a GmbH's capital over time. So whilst you may need less money at the outset, it's not that you can save on that capital expense forever. It's just a different way of getting to the same end. So cheap at formation does not always mean it's cheapest overall, because you may lose business along the way for that people are worried about engaging with a UG. In closing, the main message is do not rely on labels or just rough translations that compare a German corporate form to whatever you are familiar with. Use the right German entity for the real commercial object, and that may be different to what you are used to. So feel free to seek advice.